Well, it seems like people are done with Opendoor. We have many people, including other YouTubers, saying that Opendoor is the next Carvana, which, if you haven't heard, Carvana fell over 30% in one day after it was reported that there is a high likelihood of debt restructuring that could leave the equity worthless in a bankruptcy scenario or highly diluted in a best case. So with there being tremendous fear of Carvana going under, it has led many people to believe that Opendoor is in the same position. In this video, I'm going to go over the risk for Opendoor and share what I expect from the company. But I don't want to waste your time, so let's go ahead and dive right in. When we look at the real estate market, there's simply just not a lot of action going on. Mortgage applications continue to fall, home sales have plummeted, and despite mortgage rates falling over the past couple of weeks, we are not even close to where we used to be. So the question going into this past earnings report was, how badly did Opendoor do? I'm sure nobody thought the company had great news for Q3, but I think when we look at the numbers, we can find some risk to consider going into 2023. Looking at revenues, they were expecting to cut this metric in half from the previous quarter to between 2.2 billion and 2.6 billion. And with what we've seen in the housing market over the past few months, I think many people expected the company to either just be in line with expectations or miss on revenues. But the company actually reported $3.4 billion, which is up 48% from the previous year. Now, even though this may seem like great news that the revenues beat estimates tremendously, it's important to note that they did take a hit in order to reach this revenue number. What Opendoor did is accelerate their home sales by cutting their home prices. This means that they did lose money on some of their homes. And this is going to be important when I start talking about their guidance for Q4. There's a term that they use to define their older inventory called the Q2 offer cohort. This inventory had much lower spreads than their newer inventory, so their margins weren't as good. But the thing is that the company still has homes from before Q2, and so they are still needing to sell off these homes while prices have fallen over the past few months. And so one of the risks that I see from Opendoor is that they will continue to lose money by selling these homes at lower prices. Now, the way that Opendoor sees this is that if they can get rid of their inventory quicker, even though they would lose money on these homes, they won't need to worry about the homes that have lower spreads anymore. And going into Q4 guidance, revenues are expected to be between $2.3 billion and $2.5 billion, and these numbers are going to be dependent on a couple of factors. First is how much their Q2 offer cohort they will be able to sell. They are expecting to sell close to 65% of this inventory, so they could have this inventory for a few more quarters. If they're expecting home prices to decrease much more than they initially guessed, then they may want to sell more of this inventory, which could increase the revenue, but once again destroy their adjusted EBITDA, or earnings before interest, taxes, depreciation, and amortization. So another risk is that the home prices not only continue to decline, but decrease more than even they expect. In the past quarterly report, the management team wrote off $573 million for inventory valuation adjustment. This is what contributed to a gross loss. And if I'm honest, as rough as these numbers were, this was the part of the conference that I believe they did really well on. It's important to clarify that this is not a revaluation in their portfolio. This is a projection that the company has to make in order to recognize losses. And as these homes with losses are sold, this adjustment will align with homes that are expected to generate realized gains. This pulls those losses forward and get this tough time over with. But it's important to note that they have taken a conservative view on this adjustment. So unless these home prices fall even further from their current stance on the housing market, then they are well prepared to withstand the housing pressures. Now let's look at the adjusted EBITDA that I mentioned earlier. They expected to be between negative $125 million and negative $175 million. But because they sold more homes to get rid of their old inventory faster, their adjusted EBITDA was even lower at negative $211 million. However, the newer inventory didn't have as much of an effect this quarter in comparison to Q1 of next year. So this quarter had really poor margins, and this will continue going into the following quarter. Now, the reason for this is very important in my opinion. Without even thinking about what is going on in the current housing market, Q4 is always a tough quarter when it comes to sales. So when you include the fact that home sales have fallen drastically, this is going to be an even tougher quarter, which could push down home prices. And for Q4, they are expecting adjusted EBITDA to be between negative $335 million and negative $355 million. Now, they did say that they are anticipating the contribution profit to bottom in Q4, which is nice to see. Think about it this way. Opendoor is expecting home prices to decline going into 2023, and because they have been extremely conservative with their numbers, they are able to get ahead of the curve and have decent margins. But there is also the obvious risk that if home prices fall more than expected, Q4 may not be the bottom for Opendoor in terms of adjusted EBITDA losses. Now, I do believe that they have done the best they could to pivot by increasing the spreads on newly acquired homes, but also they have reduced operating expenses drastically quarter over quarter. quarter. In Q3, they had operating expenses in line with their guidance at $190 million, but for Q4, they are expecting to reduce that number to $145 million. Plus, they are estimating to reduce operating expenses by $110 million for 2023. But going back to Q3, there was one thing I was not pleased with, and that was the conversion rate. In their Q1 report, they had a conversion rate of 35%, and unfortunately, that is not what they got for this earnings report. The former CEO said that their current true seller rate was between 10 and 15%, so that's not even close to what they had before. But the reason for this reduction is important. The company is trying to protect themselves and their margins so the increased spreads allow them to buy houses cheaper. The risk here is that with a lower conversion rate, this may have a negative effect on customer reviews because consumers aren't getting the offers that they want. I know and recognize that a few people have had bad experiences with Opendoor, and this could continue, especially if the offers are lower than expected. However, I do believe that their new product will not only help them improve the relationship they have with their customers, but also get more revenue to the bottom line. Opendoor has always had what is called their first-party business, which is where the company buys homes from one party and then does minor repairs so that they can sell it to another party. But now, their new product, which is their third-party business, allows Opendoor to be the middleman between a buyer and a seller. This way, they are involved with the transaction, but the consumers of this product can transact directly with each other. This will make the process much more quick in comparison to the traditional MLS, and there is complete transparency on both sides because only one company is involved in the transaction. I mean, when you think about the MLS, even though it gets the job done by connecting buyers to sellers, there are a lot of steps, and that leads to plenty of delays. So this product does have the opportunity to be significant for Opendoor. Plus, rather than owning the homes and the possibility of selling them at a loss, they can make a profit just on the transaction fees. So earlier in the year, they started the buyer side of this marketplace format, which I've talked previously called exclusives, and now they have just opened the seller side. This will expand their audience because rather than Opendoor only buying certain kinds of properties, buyers can list their properties that are outside of Opendoor's buy box. But what I found interesting in the conference call is that the team continued to allude to investors buying homes with Opendoor. And they are confident that with investors and the amount of homes that are bought through Opendoor exclusives, they are aiming for 30% of the total transactions to come by way of this business in 2023. And this is important because this is a much more profitable segment for Opendoor. However, there is certainly the risk that this product falls flat on its back because it really isn't much of a difference from the MLS. I mean, for them to charge a fee, the work that they do has to be worth the price. But there was another part of Opendoor's earnings that I did not expect, and that's how bad the days on market were. In Q2, they reported 5% of their homes were on the market for 120 days. However, this quarter, that number increased to 21%, which was higher in comparison to the overall market. Now, I do believe much of this was due to their homes being skewed to longer dated homes because they have reduced the amount of homes acquired. And even though this makes sense, there is certainly the risk that they will continue to hold homes for even longer. And one thing that I liked about Opendoor when I initially bought them was that they would only hold homes for a short amount of time, so they weren't affected as much in terms of price drops. So this will be something I'll pay close attention to moving forward. Onto the balance sheet, the company continues to have a solid capital position. As of September 30th, the company had $11.8 billion in borrowing capacity and 70% is committed, so a good amount of this is obligated by the lenders despite the crazy market that we're in. Plus, it's important to note that even in October, Opendoor is increasing capacity on an existing facility from $750 million to $1 billion. So this gives confidence that the company will be able to get through this rough time. On top of this, the company has $1.5 billion in cash and cash equivalents and $1.5 billion in equity for their homes. They are also planning on financing $349 million, and that will give them an even stronger cash position to start buying homes. The team continues to reiterate that they feel like that they are in a strong capital position, and this could be the case. But at the same time, we have seen companies like Tattooed Chef have a great cash position and then waste it all in a year. So the risk is that they won't have the capital to last through 2023. And I think this is going to be dependent on if Q4 is going to be the bottom in terms of margins. If we see home prices drop steeper than expected, they could be in serious trouble. And this leads to the next metric that I was paying close attention to, which is their contribution margins. This is really telling of how the company is doing in a lower transaction market. They have been around 4 to 6% in the last couple of years, but this quarter was not good. They had a negative contribution margin of 0.7%. However, when we look at their projected contribution margin for the year, despite these massive macro shifts in the housing market, they are still expecting to be at 3.5%. Over the long term, they are expecting to get up to 7 and 9%, but if they don't get a strong enough response for the current spread, they may have to increase their buy price, which decreases these margins. Lastly, I want to touch on the change in the management team, as the CFO is now becoming the CEO and the previous CEO is now president marketplace. I really don't see this having a major impact on the company. I mean, when you listen to the conference call, Carrie Wheeler, the new CEO, did a lot of the talking, and she has done well answering the questions that analysts have. But I recognize that there is a risk that the company shifts because of the change in management team dynamics. So those are the risks that I see from Opendoor. I'm not going to say that there is no chance for the company to go under, but I do see opportunities for them to get through this tough housing market. In terms of what I'm doing with the company, I'm just holding shares. This position is a small part of my overall portfolio, so if it does go under, it won't really affect me. And because I personally don't see the company going under, it doesn't make sense for me to sell my shares. Going into 2023, I've put myself in a phenomenal position to buy some of the larger caps that have fallen drastically over the past year. And so be on the lookout for my videos over the next few weeks. Hope you all enjoyed this video, and I'll see you in the next one.